Can you really live off dividends? Yes, but probably not with the number most investors imagine. A 3% portfolio yield generates $30,000 per year for every $1 million invested. At 5%, that number becomes $50,000. But dividend investing is not really about the yield you see today. The real question is this: can that income survive inflation, recessions, dividend cuts, valuation compression, and decades of withdrawals? Because sustainable passive income is not built by buying the largest number on a stock screener. It is built through businesses with durable free cash flow, conservative payout ratios, wide economic moats, and a long culture of dividend increases. That is why Dividend Kings and Dividend Aristocrats matter. Not because of the income alone, but because they reveal something deeper: discipline. They show that a company continued raising dividends through inflation shocks, interest rate cycles, recessions, and market crashes. In this video, we will calculate the real math behind living off dividends. We will analyze 4 dividend growth companies, estimate income from a realistic portfolio, project yield on cost over time, and identify the danger zone that quietly destroys dividend investors. Let's use 4 examples: Johnson & Johnson, Procter Gamble, Coca-Cola, and Realty Income. Johnson & Johnson, ticker J&J, currently shows a dividend yield around 2.4%. It is a dividend king with more than 6 decades of annual dividend increases. Its appeal is not maximum yield. Its appeal is healthcare durability, global scale, and a long-term economic moat built around pharmaceuticals, medical technology, and brand trust. Recent data places J&J's yield near 2.41%. Procter & Gamble, ticker PG, offers a forward dividend yield near 2.98%, with a 5-year dividend growth rate around 6%, and a payout ratio near 61.55%. PG has raised dividends for 68 consecutive years and paid dividends for more than 130 years. That is the profile of a mature dividend king. Not explosive, but highly resilient. Coca-Cola, ticker KO, offers a forward dividend yield near 2.70%, with a 5-year dividend growth rate around 4.6%. Its payout ratio remains in the mid to high 60% range. KO has increased its dividend for 63 consecutive years, making it another dividend king. Its moat comes from distribution, brand power, and global beverage scale. Realty Income, ticker O, is different. It is a REIT, not a traditional operating company. Its dividend yield is around 5.24%, and its dividend is paid monthly. For REITs, the AFFO payout ratio matters far more than standard earnings payout ratios. Recent data places Realty Income's AFFO payout ratio between 72 and 75%, with a 5-year dividend growth rate near 2.8%. Together, these companies reveal the trade-off. Higher current yield often means slower growth. Lower current yield may offer stronger long-term compounding. Now let's do the math. An investor wants $50,000 per year in dividend income. At a 3% portfolio yield, the required capital is approximately $1.67 million. At 4%, the requirement falls to $1.25 million. At 5%, the number reaches $1 million. But this calculation only describes year 1. The real engine behind dividend growth investing is yield on cost. A portfolio that begins with a 3.5% dividend yield and grows dividend income at 5% annually can roughly double its income stream in about 14 years. That changes the entire equation. A $1 million portfolio yielding 3.5% starts with $35,000 in annual income. After 10 years of 5% annual dividend growth, that income becomes roughly $57,000. After 20 years, it approaches $93,000 without adding new capital. That is the power of compounding. Market prices will fluctuate, interest rates will move, valuations will expand and contract. But if the underlying businesses continue growing free cash flow and continue raising dividends, The passive income stream becomes stronger over time. This is why dividend growth investing is not simply about maximizing current yield. It is about purchasing future income at a rational price. The danger begins when investors confuse yield with safety. A 9% dividend yield can look attractive, but sometimes it is a warning signal. If the stock price collapses faster than the dividend is reduced, the yield appears artificially high. That is the classic dividend trap. The first line of defense is the payout ratio. For most corporations, a payout ratio consistently above 80% or 90% can become dangerous, especially when earnings are cyclical or free cash flow begins weakening. Recent dividend cuts across the market have reinforced this reality. Companies under financial pressure eventually run out of flexibility, and when that happens, the dividend is often sacrificed. The second danger is valuation. Even a dividend king can become a poor investment if purchased at an extreme price. A great business bought at a stretched multiple can produce mediocre returns for years. The third danger is concentration. Living off dividends from 5 stocks is fragile. A resilient income portfolio should diversify across sectors: healthcare, consumer staples, utilities, infrastructure, financials, real estate, and selective technology. The fourth danger is ignoring taxes and inflation. A $50,000 income stream is not the same as $50,000 of purchasing power after taxes. And if portfolio income grows slower than inflation, the investor quietly becomes poorer in real terms. So, can you really live off dividends? Yes. But the math requires something most investors underestimate: capital, patience, and discipline. For many long-term investors, the realistic objective is not maximum yield. It is a balanced portfolio yielding between 3% and 5%, supported by durable free cash flow, modest payout ratios, and dividend growth capable of outpacing inflation. Because sophisticated dividend investing is not about squeezing the highest income from the market today. It is about building an income stream that can survive for decades. A high net worth investor may not need to chase an 8% yield. They may need something far more valuable: dependable income, capital preservation, and distributions that continue rising over time. The objective is not to own the highest yielding stocks. The objective is to own businesses that can continue paying shareholders when the economy becomes uncomfortable. That is why dividend kings matter, why dividend aristocrats matter, why economic moats matter, why free cash flow matters, why expense ratio discipline matters, and why compounding changes everything. Because ultimately, the most important question is not how much income a portfolio produces today. The real question is this: would you rather begin with a higher yield now, or accept a lower yield from stronger businesses that may compound your income for the next 20 years? Share your answer in the comments.